Most traders don't fail because of their strategy, they fail because of their psychology. Hidden biases quietly sabotage your trades, drain your account, and make you repeat the same mistakes over and over. If you've ever asked yourself, why do I keep losing even when my setup looks perfect? This video is for you. In this video, you'll uncover 7 psychological biases that can ruin your trading account. Analysis paralysis, tunnel vision, the $500,000 lesson in herd mentality, loss aversion, projection bias, fear of missing out, the illusion of control, plus real chart examples that show how these biases destroy trades and real-time solutions so you can fix them while they're happening. Before we get started, don't forget to like this video, subscribe to the channel, and hit the notification bell so you never miss the next trading psychology tip that could save your account. Let's get started. The first and most dangerous psychological bias in trading is something called the sunk cost fallacy. This happens when you know you're wrong, but you refuse to exit because you've already invested too much. Let me share a real story from one of my subscribers. For privacy, let's call him Emmanuel. Emmanuel is a supply and demand trader. On the Australian dollar, Canadian dollar 1-hour chart, the market was trending down. He spotted a clean supply zone, saw price reject it, and got excited. Convinced the market was about to drop, he went in heavy, risking more than 25% of his account on a single trade. At first, the market moved slightly in his favor, but then it reversed. Now here's the critical moment. Instead of letting his stop loss do its job, Emmanuel removed it and kept watching, hoping the trade would come back. But it didn't. Price kept climbing, his losses grew, and before long, more than 60% of his account was gone. He couldn't bring himself to close it, and eventually he lost 75% of his account in one trade. When I asked him why he didn't exit earlier, he admitted, "I risked too much. It was too hard to accept the loss." That's the sunk cost fallacy in action. The more you risk, the harder it becomes to admit you're wrong, and the more damage it does to your account. So how do you avoid this trap? First, never risk more than 2% of your account on a single trade. That way, if you're wrong, it's easy to exit and move on. Second, always keep a stop loss in place. Remember, the market's potential to move against you is unlimited. The longer you resist closing a bad trade, the harder it becomes, until it wipes you out. Another common mistake traders make is relying on too many indicators. Just look at this chart. It's loaded with moving averages, stochastics, RSI, Bollinger Bands, even Fibonacci retracements. Instead of clarity, you get chaos. The screen looks overwhelming, and the signals often contradict each other. If you can't read your chart with confidence, how can you possibly make a clear trading decision? Now let's strip the chart down and remove all the indicators. Notice the difference? Suddenly, the chart is clean, simple, and easy to read. You can clearly see price action. The market broke above a resistance level and is now pulling back to retest it as support. The picture is straightforward, and that clarity makes it much easier to anticipate what's likely to happen next. This mistake comes from something called analysis paralysis. It's a psychological trap where you add so many tools, so many signals, that you end up overthinking every move. Instead of finding clarity, you get stuck in confusion and indecision. And here's why it happens. The first reason is fear of being wrong. Many traders pack their charts with indicators because they're scared of making mistakes. They think more tools will give them more certainty, but in reality, it only creates hesitation and doubt. The second reason is a lack of trust in simplicity. A lot of traders believe trading has to be complicated to work. They ignore simple, proven methods like price action and chase complexity instead. And finally, overconfidence in indicators. Indicators can give a false sense of security. Traders rely on them as if they can predict the future. But the truth is, indicators only show what has already happened. They lag behind the market, and that makes you late to the move. So, how do you break free from analysis paralysis? Step 1. Set clear rules. Define your strategy and stick to it. Choose 1 or 2 trusted tools like price action or Fibonacci, and avoid cluttering your chart with noise. Step 2. Keep it simple. The clearer your chart, the clearer your mind. Fewer distractions lead to better, faster decisions. Now let's move on to another psychological mistake that can ruin your trading account. Tunnel vision. Tunnel vision is a bias that happens when traders focus too much on one small detail, like a single time frame or setup, and completely ignore the bigger picture. It blinds you to what's really happening in the market. Let me show you how this mistake develops and why it's so critical to fix. Take a look at this New Zealand US dollar 5-minute chart. At first glance, it looks like the perfect setup. We've spotted a strong demand zone, it's fresh, the move into it is sharp, and the candles are big. The reward to risk ratio looks fantastic. When price tapped into that zone and quickly rejected, forming a liquidity sweep, it seemed like the ideal entry. So we took the trade. But as you can see, it failed. So why didn't the trade work out? It's not because the supply and demand strategy is broken. The problem was that we ignored the bigger picture, the higher time frame. When we switch to the hourly chart, the mistake becomes obvious. The market had just rejected a strong supply zone. That supply zone is a clear warning sign that the market is more likely to push lower, targeting the hourly demand zone. Now, when we zoom back into the 5-minute chart, the demand zone still looks strong, but the conflict is clear. We were trading against the higher time frame supply. And whenever signals conflict, the higher time frame almost always wins. That's exactly why this setup failed. So why do traders ignore the bigger picture? It comes down to a psychological trap called tunnel vision, also known as narrow framing. This happens when you lock in on one tiny detail of the market, like a single time frame or setup, while completely ignoring the broader context. It's a cognitive bias that blinds you to what's really happening. Most of the time, it's fueled by impatience and the constant urge for quick results. So how do you fix this mistake? The answer is simple. Use top-down analysis and always factor in the higher time frame. Here's how to do it step by step. If you're trading on the 5 or 15-minute chart, check the hourly chart first to understand the bigger trend. If you're trading on the hourly chart, look at the daily chart for confirmation, and if you're trading on the daily chart, zoom out to the monthly chart to see the full picture. By doing this, you align your trades with the market's overall direction and avoid setups that go against the higher time frame. In trading, context is everything, and the higher time frame always provides that context. Let me share a story I'll never forget. A real and heartbreaking example of how herd mentality can destroy not just finances, but lives. For privacy, I'll call him Adam. Adam and his wife spent 23 years working hard, saving every penny and building up $500,000, their life savings, meant to secure their future. But in May 2021, everything changed. Dogecoin was everywhere. Social media, the news, even dinner table conversations. Influencers and celebrities, including Elon Musk, were hyping it up. By May 8th, Dogecoin hit its all-time high of $0.73, and everyone was convinced it was going to $1.00 or higher. Adam got caught up in the frenzy. He believed this was his once-in-a-lifetime shot to become a millionaire. Ignoring my warning, he went all in. On May 7th, the day before the peak, Adam invested their entire $500,000 into Dogecoin, absolutely certain he had made the right decision. Then came Elon Musk's Saturday Night Live appearance. One joke, calling Dogecoin a hustle, sent the hype into free fall. Within days, Dogecoin dropped to $0.50, and by the end of the month, it was down to $0.30. Adam's $500,000 was slashed to less than $250,000. The financial loss was devastating, but the emotional toll was worse. The trust between him and his wife shattered. Arguments turned into resentment, and eventually their marriage ended in divorce. Adam's mistake wasn't just financial, it was psychological. He fell into the trap of herd mentality, when the excitement of the crowd blinds you to the risks. If you're watching this right now, consider yourself fortunate, because you have the chance to learn from one of the most dangerous trading mistakes: herd mentality. The crowd is usually wrong, especially at the very peak of hype, and that's exactly when traders get burned the most. Adam's story is a painful reminder that chasing the crowd can cost you everything: your savings, your relationships, and even your peace of mind. But here's the good news. You're here, gaining the awareness to avoid falling into the same trap. So how do you break free from herd mentality? Before you follow the crowd, pause and ask yourself these 3 critical questions. Am I making this decision based on my own analysis, or am I just swept up in the hype? What's the risk if this trade goes against me? And most importantly, can I truly afford to lose the money I'm about to invest? These simple but powerful questions force you to step back, think independently, and protect yourself from one of the most dangerous psychological traps in trading. Now let's talk about another psychological bias that quietly sabotages traders: loss aversion. Let me share a secret with you. Your trading strategy can have a 99% win rate on paper and still fail in real life. Why? Because trading isn't just about strategy, it's a battle of nerves. The market is a master at playing with your emotions, and if fear or frustration takes over, you'll fall right into its trap. Take this real chart example. You've identified a strong demand zone. Everything looks perfect. The candles are large, the zone is fresh, there's a clear break of structure, and the risk-to-reward ratio is spot on. Confidently, you enter a buy trade with your stop loss just below the zone. But then it happens. The market dips lower, breaks below the demand zone, and your stop loss gets triggered. Frustration hits immediately. It feels like the market is hunting you down. But here's the truth. This isn't random. What you just experienced is likely a liquidity sweep, a smart money move designed to trigger stops and grab liquidity. Now comes the moment of truth. Do you react emotionally and quit, or do you think like a pro? Watch closely. The market comes back to the same demand zone, and this time it closes above. That's your signal. The first dip was a liquidity grab, not a real breakdown. At this point, you have two choices. Let frustration hold you back, or calmly re-enter with a refined plan. A disciplined trader chooses the second option. You re-enter, place your stop loss just below the new low of the demand zone, and target the next level. And guess what? The market rallies in your favor and hits your target. That's a win, not just in money, but in mindset. You didn't let your emotions control you. You outsmarted the market's psychological game. This isn't a rare scenario. It's something you'll face again and again, no matter what strategy you trade. Whether it's supply and demand, Fibonacci, or any other method, the market will always test your nerves. The key is learning how to stay composed and handle it like a pro. Now let's talk about a mistake that can quietly drain your account faster than you think. Projection bias. Let me walk you through how this mistake usually plays out, and more importantly, how you can avoid falling into the trap. Here's how projection bias plays out. The market is in a strong uptrend and you spot a resistance level. You think to yourself, price is too high, it has to reverse here. So you enter a sell trade, expecting the market to turn. But it doesn't. Price smashes through resistance and keeps climbing. Frustrated, you double down at the next resistance, convinced it has to reverse this time. But again, the market keeps pushing higher, and with every failed attempt, your losses keep stacking up. The same mistake shows up in a downtrend. Traders assume the market is too low and expect a bounce, so they jump into buy trades far too early. But instead of reversing, the market slices through support levels and keeps falling, turning those trades into even bigger losses. This isn't bad luck, it's projection bias. Traders project their own beliefs onto the market, expecting reversals without any real confirmation. But the market doesn't care about what you think should happen. It moves on supply, demand, and momentum, not your assumptions. To overcome projection bias, you need to shift your mindset. First, accept that the market is never too high or too low. Trends can extend much further than what feels reasonable. Second, base your decisions on evidence, not assumptions. Use price action, breakouts, or candlestick patterns to confirm your idea. And third, always wait for confirmation before betting on a reversal. Look for signals like a change in market structure or a clear rejection at a key level. By avoiding projection bias, you'll make smarter, more disciplined decisions. Now let's move to another mistake, one that's more common than you think, no matter what style of trading you use. For this example, we'll use a supply and demand strategy, but trust me, this applies whether you're scalping, swing trading, or day trading. Here's the situation. You're watching the charts and spot the perfect supply zone forming. The setup looks flawless, the kind of trade that feels like a no-brainer. But then, distraction strikes. Maybe you get a notification from a trading group hyping another market, or you scroll through social media and see someone bragging about massive gains. And you feel it, that itch. What if I miss this trade? You rush in, place a limit order at the supply zone, convinced the market has to respect it. But when you come back, reality hits. The trade failed. Maybe your stop loss got hit, or the market simply ignored the zone. Here's the hard truth. That wasn't bad luck. It was bad trading. You let the fear of missing out take over, and you skipped the most important step, confirmation. A supply zone is just one piece of the puzzle. Who said the market must respect that zone? Trading isn't about guessing. It's about stacking confluence and waiting for all the pieces of your strategy to line up. If you skip steps and rush in, you're not trading, you're gambling. So how do you avoid falling into this trap? Shift your focus from fear to strategy. Opportunities are endless in the market. Miss one? So what? Another setup will always come. In 5 minutes, an hour, or tomorrow. The market never runs out of opportunities. Wait for confirmation. Whether it's a break and retest, a price action signal, or another tool in your system, make sure the market validates your zone before you commit. Confirmation isn't optional, it's essential. Trust the process. Every strategy, from supply and demand to Fibonacci, only works if you follow it with discipline. Rushing a trade because of FOMO doesn't improve your chances, it destroys them. Now, let's look at another all too familiar scenario. You're analyzing a chart in a range-bound market. Price breaks out, pulls back, retests a level, and prints a beautiful pin bar rejection. Perfect setup, right? You enter, place your stop loss just below the pin bar's tail, and set your target. Everything looks textbook. But then, the market dips just enough to hit your stop loss, only to reverse and run straight to your target without you. Sound familiar? It's one of the most frustrating experiences in trading. You did your analysis, spotted the right setup, but still walked away with a loss. Why? Because your stop loss was too tight. You didn't give the trade enough room to breathe. And here's the key. This isn't just a technical error. It's a psychological one. This mistake comes from a powerful psychological trap called the illusion of control bias. In trading, this bias makes you believe that placing a smaller stop loss somehow minimizes your risk. On the surface, the logic sounds right. The closer my stop loss is to my entry, the less money I'll lose. But this is an illusion. A tight stop loss doesn't protect you. It just increases the chances of being taken out by normal market fluctuations, even when your trade idea is correct. So now you've seen how these psychological biases can quietly destroy a trader's account if left unchecked. The key is being aware of them and training yourself to react differently. If you found this video helpful, make sure to give it a like, subscribe to the channel, and hit the notification bell so you don't miss future videos on trading psychology and strategies. Thank you for watching, and see you in the next video.